Hey everybody, welcome back to Whiteboard Finance. My name is Marco and I'm here to help you master your money and build your wealth. In today's video, we're going to be talking about how the Federal Reserve is buying individual corporate bonds. Yes, you heard that correctly. A central bank is buying individual corporate bonds. So you may have no idea what I'm talking about. You may have been following this pretty closely, but in this video, we're going to simplify that for everybody to understand what's really going on in the economy and also in the American markets. So the Fed, who's supposedly supposed to be the lender of last resort, has actually started buying these corporate bonds as mentioned. In March, they announced that they would start doing it. In May, they started buying bond ETFs, and now fast forward at the time of this recording in June, they are now purchasing individual bonds. So in this video, we're going to talk about the facility, aka that's just a fancy finance term for the loan. We're going to talk about the eligible assets that they may purchase. We're going to talk about the eligible issuers who can actually issue these bonds based on their ratings and things like that. And then to wrap up the video, as usual, I'm going to give my thoughts on the subject at the end. So stay tuned. So let's talk very quickly about the facility, aka the loan that the Fed created to be able to buy up these individual corporate bonds. So we have here the SMCCF. This stands for the Secondary Market Corporate Credit Facility. This is basically just a fancy acronym that says, hey, we're raising this money in this facility to buy corporate debt, aka bonds, on the secondary market. So if you don't know the difference between a primary market and the secondary market, the easiest way and quickest way to explain this is that the primary market are basically where companies go to float or sell shares of their IPO, their initial public offering. This is when a company goes from private to public, for example. So you get a bunch of underwriters, they say, hey, Uber, your company's private, but we think that your stock is going to be worth $15 a share upon IPO. Let's offer it to the public at that rate, okay? Secondary market is basically just what you and I know as the stock market, okay? So the New York Stock Exchange, NASDAQ, et cetera, et cetera. So if you look at this acronym, the secondary market, that means that this is going to be involved in buying debt from the market at market rates, secondary market, okay? Get it, got it, good. And if you don't, just rewind it like 13 times, you'll understand it. So the New York Federal Reserve is basically lending to a special purpose vehicle called an SPV, that's just the acronym, to buy corporate debt, aka bonds. So if you don't know what an SPV is, and I'm sorry you guys, you need to understand what these acronyms stand for in order to understand what this video is even talking about, so I have to explain these. So an SPV is basically a subsidiary created by a parent company to isolate risk. So think of it as like a LLC. So I'm Marco, I own a McDonald's. I don't own it in my personal name. I own it in an LLC or a separate entity to separate the two, okay? So that's basically what they did. They started this SPV. So the Department of the Treasury actually committed $75 billion as well. So they committed $50 billion to a primary market corporate credit facility. That was on March 23rd when they first announced that they were doing this. And they're committing $25 billion towards this one, the secondary market corporate credit facility. So this is actually going to be a total of $750 billion that can be pumped up into buying these different corporate bonds. So you're probably wondering to yourself, Marco, how did you add 50 plus 25? That should be 75 billion, right? How did you get 750 billion? Well, I'll tell you exactly how in the next slide. Okay, so let's talk about how the Fed can actually take that 75 billion and leverage it up to 750 billion. And I'll explain to you exactly how in this slide with the eligible assets that they're actually going to be gobbling up with this fund. So the first one is individual corporate bonds, which is the entire point and the entire thesis of this video. They can actually leverage that 75 billion 10 to 1. So 75 times 10, that's 750 billion, okay? That's how they came up with that number. Number two is ETFs. These are bond ETFs. They can also leverage that up 10 to 1. And then finally, you have broad market bonds, which you can leverage up 3 to 1 to 7 to 1, depending on the risk. So just so you guys know the criteria that they're going for, they're not just out there buying, complete junk bonds and everything left and right. There's certain criteria that they need to meet, and I'm actually going to read that right now. If you don't want to listen to this, skip forward about 20, 30 seconds. So with the eligible individual corporate bonds, the facility may purchase individual corporate bonds that at the time of the purchase by the facility, they need to be issued by an eligible user. They need to have a remaining maturity of 5 years or less, and then the bond needs to be sold to the facility by an eligible seller, okay? So the second one is eligible ETFs. So this basically boils down to the majority primary objective is exposure to US investment grade corporate bonds, and the remainder of the ETFs that they buy has exposure to high yield corporate bonds. And then finally, the broad market index is basically a little bit more complicated, but it's important for you guys to know this. They're issued by an issuer that is created or organized in the United States or under the laws of the USA. They're issued by an issuer that meets the rating requirements for eligible individual corporate bonds, which we'll talk about in this video. Number 3, they are issued by an issuer that is not an insured depository institution, basically not a bank, etc., etc. They have a remaining maturity of 5 years or less. Okay, so I know that was kind of boring, but it's important for you to understand the criteria, and we're going to go into the third part of the video, who are the eligible issuers. Okay, so who are these eligible issuers? Meaning, who are the organizations or the entities that can offer up their corporation's bonds for purchase through the SMCCF? So this is going to be a little bit repeating of what I said last time, but it basically boils down to you have to be a USA business, as mentioned. You have to be rated at least BBB minus. So it's just on the border of investment grade. You're basically on the border of junk and investment grade. It can't be a bank, can't have CARES Act support from the previous stimulus, and then you can't have a conflict of interest defined by basically the CARES Act. So I can leave this up on the screen, but I just want you to take a look at this bond chart real quick. So I think it's important for you guys to understand that a lot of these companies are actually being downgraded during this time. I'm actually going to show you a couple tweets at the end of this video that are pretty interesting and pretty telling. But before I do that, let's actually just move on to my final thoughts when it comes to the Fed actually buying up these individual corporate bonds. Okay, so my final thoughts are that this basically ends up being a slippery slope of nationalizing the market. So what do I mean by this? So if you look at all these times of distress, you had quantitative easing 1 after the great financial crisis. You had quantitative easing 2, 3, 4. It basically just keeps happening, but bigger and bigger. If you look at the amount of money that the Fed has printed off in just the past 2-3 months, it actually eclipses what the Fed did during the great financial crisis over the course of 2 years. So it just keeps creating a bigger and bigger bubble. But what I mean by nationalizing the market is that simply, I started this video by saying the Fed is supposed to be the lender of last resort, and it seems like they're becoming a market participant with all the money printing they're doing. So what do I mean by this? So instead of basically letting free market capitalism kind of wring out the companies that are zombie companies, which is a subject for another video, and basically letting them go out of business naturally, kind of like a forest fire takes care of dead shrubbery, which actually provides nutrients for the forest. They're actually letting these dead shrubs survive, if you will. So basically, first they said that they're going to be buying bond ETFs. That was in March. Then in May, they started doing it. Now in June, they're going to individual corporate bonds. Next, what people think they're going to start doing is buying equity ETFs, aka stock ETFs. So what's going to happen a couple months after that? Maybe they'll start buying individual stocks, aka individual companies, aka owning a piece of a publicly traded company. So that's nationalizing a publicly traded company, similar to what you have in other countries around the world. And then finally, if they start buying individual stocks, what's to stop them from being a minority and then eventually a majority shareholder of these companies? So I think that what they're doing, I understand what they're trying to do because they have no choice. They have to print money and they have to be a market participant. Otherwise, it may spark a revolution. You should read The Lords of Finance if you haven't already. But ultimately, I think that it's going down a slippery slope and it needs to stop naturally at some point. Otherwise, you just have a manipulated market. So those are my 2 cents on this subject. You can disagree with me, you can agree with me. I'm just a guy on YouTube. But at the end of the day, I hope you got value out of this video. Please share it with someone who's interested in stuff like this. I know more people are interested in like the Kardashians and reality TV and things that don't really matter. But when it comes to stuff like this could actually impact not only your life, but also your kids and also your grandkids. So keep that in mind. As always, everybody, have a prosperous day. Check out the links in the description below if you want to learn a little bit more about things that I provide for free. Thank you so much. Hey, Grandpa, can we go get a Happy Meal? Oh, sorry, little Billy. Happy Meal is $743.